Hello again, this is Professor Hazera, and this is the last recordings of the problem that we went over on November 17th, which includes both non-controlling interest in a year subsequent to acquisition. And I can't repeat it enough, this is what your test is going to look like. Okay, so I'm just going to start with a sheet because by now you should be familiar with the problem. Sheet's right here. Okay, and we had done all these entries. Keep in mind that this dividend receivable was a correcting entry, and all we're going to do in this video is post these entries to the consolidation and finish consolidation. Keep in mind we're aiming for two things. We're aiming to eliminate the income from sub, and we're aiming to eliminate the investment account. The investment account, after the correcting entry, will have $544,000 in it. So I'm going to use the letter C for the correcting entry. You'll notice that C, I have two C's here, and they're both the correcting entry. The first one is we're going to debit dividends receivable for $16,000 because they owe us dividends, but we'll end up eliminating that anyway because you can't owe yourself dividends. And we're going to credit, they just see right here, the investment account for $16,000 because the parent did not make the equity method journal entry. Okay, so after you've made that entry, then you can finish with the big four entries. Okay, the first one is, there's a pattern here after a while. Debit income from sub for $76,000. Credit dividends for $32,000, and that's done on the statement of retained earnings. We'll do that for $32,000. And then the difference between the 76 and the 32, and we'll go down here to the investment account, and we'll do an entry number one there. The difference there is for $44,000, which is the difference between the ending investment of $544 and the beginning investment of $500,000. The purpose of speaking of $500,000, the purpose of the second entry is to eliminate these two equity accounts, write up these two asset accounts, but more than anything is to eliminate that $500,000. Okay, so the second entry always begins with the elimination, that's entry two there, you see, of the subsidiary's common stock. This one never changes. And then also, the elimination of the subsidiary's retained earnings. Now, the common stock is also considered the beginning balance of the common stock account, but we assume stock doesn't change. Okay, and then we're going to write up the buildings. We're going to write up buildings for their correct beginning balance as of the beginning of the second year, which is $100,000 less $25,000. And then we're also going to write up goodwill, which wasn't even on, if you look over here, wasn't even on the parent's balance sheet. So the goodwill is being created through the consolidation. So we'll come down here and we will do goodwill. Okay, then we've got two credits. The first one is the big one. That one is to eliminate the investment account. You see the entry 2 there. This is going to be to eliminate the investment account. Let's slow that one down. And the second one is going to be, you always come down here, is to establish, and you'll see that says number 2 there, to establish your non-controlling interest, your beginning non-controlling interest. And that is for $125,000. Okay, and our entry should balance. I'm going to go ahead and sum the entries up. I like to sum these things up as you go along because to make sure that something spotted something wrong when you see it. And we'll copy that over. And something apparently is a little bit off here. Let's see. We're not in entry 4 yet. I may have left that in from the previous problem. Not an entry 7 either yet. 717, 717. Okay. So we look good now. Okay, so then the next couple of entries are pretty easy. Record your current year's depreciation for the plant assets, which will bring them down to their value at the end of 2012. So we've got, I'm going to debit other expenses because there's no depreciation expense. And then we'll credit plant assets. That would include buildings for $25,000, which is the 2012 expense. That's why I put to record depreciation 2012. And notice that if you look at the 75 and the 25, you've got 50 left over. And that's just the last, it had a 4-year life. 2 years have already been recorded. So you're going to start next year with $50,000 in there. Okay, and so that's that entry. And then in entry number 4, we update the non-controlling interest. The totals look good here. The update to the non-controlling interest is going to be, you're going to debit. This is probably one of the more important debits there, where it says non-controlling share of income. We consider that to be an expense because it doesn't belong to us. That's $19,000. We're going to credit dividends, which is the remainder of the dividends, for $8,000 right there. And the difference between the 19, and the 8,000 is the $11,000 increase in non-controlling interest during the year. Okay, so go up here, and there's your non-controlling interest increase, $11,000. Okay, then we're balancing so far. So we finished the big 4, and the only thing we have left are these little dinky receivables payables. So in entry number 5, we're going to debit accounts payable for $10,000 and credit accounts receivable for $10,000 right there. Dividends receivable, well, we actually established dividends receivable of 16, but we can't owe ourselves dividends, so we're going to credit dividends receivable for 16 and debit dividends payable for 16 also. Okay, and then the final entry, number 7, is this is one that had a very confusing language on. And there's a debit cash and a credit to an advance. They had loaned, the parent had loaned the subsidiary money, and the check was in the mail. So that's just so petty that I wouldn't, not the 70,000, but not the amount, not the 40,000, but the way they wrote it up. So I'll just go ahead. 7 is 40, and then there's advance to psi, which is 40, which will leave it at 0 actually. Okay, so let's see if our entries total. They do 827. Now we can finish the consolidation. Remember, work across, work down. Sales, 2.4. Income from sub, 0, because you'd be double counting. Then cost of goods sold, 1.5 million. Operating expenses is 380 plus negative 180 minus 25. So operating expenses should be 585, which is correct, it looks like. Look at my sheet here. And then the only expense left, you could actually have a subtotal. That's actually a subtotal, but it really doesn't matter. This is going to be a negative 19. Remember, that's an expense because it's got a debit there. Okay, so our final income statement is 2,400 plus a negative 1.5 plus negative 585 plus negative 19 and 296. Notice that the 296 equals the parent's net income, so we're good. And so bring down the controlling share. It's of net income is 29. Bring it down to the statement of retained earnings, which should be right here. Okay, and then just work across on the statement of retained earnings. Parents, 244. The subs, 100 minus 100 gives you 0 retained earnings for the sub, and that's correct, or else you'd be double counting. And then the dividends are 200,000 plus the negative 40. That would give you a negative 240, but then you would add back 32 and 8. That gives you 200,000. So basically, that's the parents' retained earnings. So we got 244 plus net income 296 minus dividend 200,000, 340. And let's just bring that down. I put that on the wrong line. Let's just bring it down to the next line. We'll just do the recalculation on the next line. 244 plus 296 minus 200, 340. So 340 equals the parents. And the statement of retained earnings, once again, is exactly like the consolidated parents are identical. Now we just finish the balance sheet. Make sure to bring the retained earnings down, 340 down, and of course the 340 equals the parents' retained earnings. And now we're just ready to finish up this. Cash is 12 plus 30 plus 40. So cash is 82,000. Accounts receivable is 52 plus 40 minus 10. That gives you 82,000. Then inventories is 164 to 120, 284. Advance should be 0 because you can't owe yourself money. That's why we made entry 7. Other current assets should be 170, obviously. Land should be 320 plus 60 is 380. The plant assets are 680 plus 460 plus 75 minus the 25 gives you 1190. Now the investment account is a bunch of minuses. 560 minus 44 minus 16 minus 500,000 or 0. So the investment account should give you 0 every time. Okay, dividends receivable are 16 minus 16. Right? And then goodwill is just its own asset. Okay, so let's go ahead and sum the assets up. So this is equal to sum of start with cash, go all the way down to goodwill. 2318. That is off by a little bit. So we got 8282, 284, 284. Oh, this one. This is, I even said it. That's 40 minus 40. Gives you 0. So 2238. That is the correct total right there. Okay, now we can just finish up here. So 2238 is your balancing total. I'll go ahead and put that in right there. And then we'll just finish up with accounts payable is 48 plus 30 minus 10, 68. Dividends payable is 20 minus 16, gives you 4. And that 4 is the 20% of the dividends that are due to the non-controlling interest. Other liabilities is 200 plus 90. I don't think there's anything else there, 290. Capital stock is 1,400 plus 400 minus 400. Gives you that out right there. And the only thing you have to finish now is an order, because look, you've got 2238 on one side, 2102 on the other. Don't forget your non-controlling interest. Your beginning non-controlling interest is 125. Let's get that. Your beginning non-controlling interest is 125 plus the 11. Your ending non-controlling interest is 136, so that enables you to balance out at 2238. And if you look at the non-controlling interest, the 125 plus 11 gives you 136. That reflects, in this analysis up here, that reflects this. 125 plus the 11 difference gives you 136. Okay, I'll post this, and I think this is very doable. And the test that I give you is, in fact, going to have the concepts here. It's going to be a little heavier than this, but they're going to have concepts, and I'll give you plenty of time to do it so you can relax. Okay, so I'll go ahead and post this, and we'll get the 4 videos up. Thank you very much.